On this morning's Ag Issues program, it's a pleasure, as always, to bring on to the program Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the program this morning. Roger, good morning. How are you?
Good morning, Greg. Just fine, thanks.
All right, let's get to it. A lot to talk about. And as we get to the end of September, as we have, the Internal Revenue Service provides guidance on the extension of the replacement period under certain regulations for livestock sold on account due to drought, flood, and other related conditions as well. But you've also got some updates on that, and including where that affects several Kansas counties too.
Yeah, that's right. What these are, Greg, this pertains to what are known as the involuntary conversion rules. And under the tax code that you referred to, you don't have to recognize gain when property is involuntarily converted. In other words, I'm forced to sell something more than I normally would in the case that we're going to talk about. I don't have to recognize the gain from that transaction. I can replace that property that was involuntarily converted against my will. And we see this come up in numerous ways. Maybe you've got a farm and the county wants to expand the road right of way, and so they condemn part of your property. Well, they have to pay you for that under the Fifth Amendment. You're entitled to what's called just compensation. Well, that's income to you. Normally, you'd have to report that in the year you receive it if it weren't for this special provision. Now, there's a subsection in this particular part of the code that applies this to livestock that are sold on account of drought, flood, or other weather-related condition in excess of what you would normally sell in that year. So the deferral in this instance applies to the excess number of head that you would sell. And if you normally would sell, let's say, 100 head, and now because of drought you've had to sell off 150 because your pasture's burned up, then you can defer the gain attributable to the excess 50. That's how this works. Now, you do have, because it is an involuntary conversion provision, there is a replacement rule. You have to replace those livestock that were involuntarily converted with like-kind livestock in order to use the deferral provision. Normally, that's 4 years from the date, from the close of the first tax year in which any part of the gain from the conversion is realized. But and that was increased, by the way, about 15 years ago. Well, actually, almost 20 years ago now, from 2 years. So Congress expanded it from 2 to 4, but then gave the Treasury Secretary the discretion to extend the replacement period on a regional basis as the Secretary deemed appropriate if you have weather-related conditions that result in a federal designation that the drought is continuing for more than 3 years. Now, if they find that, then they can extend it basically on a county-by-county basis for an additional year at a time. And that's what the IRS announces by the end of September every year. They're obligated to do this by statute to list what are known as the drought counties. So if I'm a livestock producer and I have livestock in these counties that have the designation, and I had to sell excess livestock, I don't have to report the gain. I get another year in which to replace the livestock and then report the gain. So what it does is it extends the replacement period until the end of the taxpayer's first tax year that ends after a drought-free year for that particular region or county. And so what they come out with is every year the counties that still have not had a drought-free year. And there's a special definition for that. And so that's what we got a week ago from the IRS.
And so it'd be determined by that or something that we report on the U.S. Drought Monitor map that can be, or basically determines the eligible locations in this case.
Yeah, that's right. The University of Nebraska-Lincoln has drought monitor maps. You can access those online. You can check those, but another way to do this is wait for the IRS to put out their guidance by the end of September every year, and you get the list of the counties.
So for Kansas this year, how many counties are eligible?
Well, I didn't count them up, but basically when you look at the map, and I just for my own purposes, and I shared this with you, I just took my pen and printed out a map of Kansas and shaded in the counties. And basically, it's the entire top tier bordering Nebraska except for Doniphan. So every single county from west to east except Doniphan is deemed to be a drought county. The next tier down, you get the first four from the west, and then Rooks and Osborne are not. And then you get the next 6 counties, and then Atchison is not. And then you drop down to the third tier, and you get the first 3 counties in from the west, and then you pick up, looks like Dickinson County, and then that's it. Around the Topeka area, you're going to get Riley and Wabaunsee, and I'm looking at the map trying to see what I colored here. Riley, Wabaunsee, Pottawatomie, and Jackson. And then back out west, on all of the counties that border Colorado, the second tier in from Colorado, all of those. And then in the third tier, it's just the top 3, and then you pick up Scott. Finney is not, which is Garden City. Haskell and Gray is not. And then on the bottom tier along Oklahoma, it's the first 6 counties in from Colorado. The rest of the state is not a drought area. Actually, the majority of the area, the geographical area in Kansas, is not listed as a drought county, so you don't get an extended replacement period. And that basically starts in Haskell, Finney, and Lane, goes all the way east. And so when you look at the map, it's essentially north and west, and then the first 6 counties along the Oklahoma border in the southwest. The rest of the state's not a drought, not listed as drought counties.
By the way, my quick count, it looks like 43 counties of the 105 would be eligible for that. So,
okay. Yeah, it's not a majority this year.
Yeah, exactly. Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, is joining us on the program this morning. And Roger, we've been talking about, of course, some of the proposed pieces of legislation concerning the taxes, and of course what is going on with the social infrastructure bill and how they would like to pay for it. And I know House Ways and Means Committee just recently released an updated legislative text, and they've got some changes, or proposed tax changes, I should say, to be included in the budget reconciliation bill. And I like the term porkulus on the spending bill as well, to talk about that. But what are some of the updates that are coming out of the House Ways and Means Committee, and what they would like to see on some of the changes they have made?
Yeah, I know we talked about this 2 weeks ago, but this continues to change, and so it's different than what we talked about 2 weeks ago. In fact, it may be different this afternoon than what I'm going to talk about here in just a moment. It now appears to me, in discussions with the tax writers that I had last week on Capitol Hill, that we've discovered enough drafting errors in the tax legislation that it's going to slow it way down. I don't think at this point in time that nothing will get enacted before the end of October, if anything. If anything gets enacted, and I'm putting the odds on actually anything getting enacted dropping as each day goes by now. It does not look, it's looking less and less likely that this is actually going to go through. I closed out a major farm conference in Iowa City, Iowa in June by telling that group then, and the nationwide online audience, that when we got to the fall, you've got to pay attention to what President Manchin says. And I said that deliberately. He's the one that's in control. He and now Senator Sinema out of Arizona are saying, no way, we're not going for $3.5 million. It's going to have to be a much smaller package. Well, then you get into the nuts and bolts of the language of the tax legislation, and frankly, there's a number of provisions that are just very messed up at this point in time. That's going to take time to unwind it, and they realize now that there are too many technical glitches to pass this as is and then try to come back and do a technical corrections bill. That's where I'm involved on this right now, is trying to make sure if they do something that you've got the language correct. Well, what has happened over the past 2 weeks is that for a big issue for farmers and ranchers is that the income tax basis issue is now gone. And what I mean by that is there was a proposal to eliminate or substantially modify, let me put it that way, step-up basis at death. Under current rules, when you die owning property, that property gets a new basis in the hands of the heirs equal to its fair market value. That would have been eliminated, and we would have gone back to a carryover basis rule. The heirs would have gotten whatever basis the decedent had at the time of death, and all of that appreciation in value would have been taxed at the moment of death, and not wait to see when or if the heirs sell the property. That would have been absolutely horrible for us to have to deal with in agriculture. Congress actually did that in the late 1970s under the 76 Tax Act, and then later on that did get removed. Because it was just an administrative nightmare from one standpoint, from a practitioner standpoint. You just can't track effectively that basis, and if you can't prove what your basis is, then the IRS presumes it's zero, which is just an absolutely horrible result. That one is now out. That's off the table, so we get stepped-up basis. Now, there are a number of other things that are becoming clear, and this is where we stand as of right now. If you have a trust, and that trust is kicking out income. And there's a lot of this in farm country because we've had one spouse die, property goes into a trust for the surviving spouse. There is business property, there's farm property inside that trust that's generating income. Now they're going to tax that. The proposal would be 39.6% with taxable income over $12,500. We need to be aware of that. That doesn't take much to get to $12,500, and you're basically then at a 40% rate. And your trust, as well as an estate, would be taxed on capital gains at a top rate of 25% rather than the current 20% capital gains rate. And then, if the trust and or an estate has adjusted gross income over $100,000, you tack on another 3% surcharge on that income. So that's going to get you to basically 43% federal, and then you have to tack on state tax on top of that. So you're basically at 50%. With respect to a trust. A lot of what they're doing is egregious with respect to trust. Then as you go up the income ladder, if you've got a high net worth individual, you're going to be subject to that additional 3% tax on AGI greater than $5 million if you're married filing jointly, or $2.5 million for single taxpayers married filing separately. That's less of a concern. There's less people in that category, but still. The federal estate tax exemption, where's that at right now? That would go back to the 2010 amount of $5 million, inflation adjusted. So a lot of us think, based on the inflation numbers since then, that starting in 2022, if this were to go through, it would be about $6 to $6.2 million, down from the current $11.7 million. Now, that is a massive change that would affect a lot of small businesses, and it would pick up, obviously, more farming operations. And so we would have to change our planning scenario and perhaps the way the farming operation is organized. We'd have to consider making gifts to move value to a subsequent generation instead of waiting for death. But that has a lot of implications to it. They're removing the ability to do some valuation discounting, and then there's a lot of provisions now that are in there with respect to retirement accounts. If I've got an IRA or I've got a 401k and I have assets more than $10 million, I can't make any more contributions if my AGI is over $450,000 or $400,000 for a single individual. So again, what they're doing is they're hitting the upper end with respect to those, and then saying, well, then you're going to have to take more out of it, which increases the amount of tax that you're going to have to pay if you're at those income levels. If you have retirement account balances of more than $20 million, then you get another distribution rule that is imposed on you also. So those are provisions. There's a few taxpayers out there with that, and that's kind of the other point with respect to this, Greg. They're increasing substantially the tax rate on very high income individuals. There's just not enough of those out there to generate enough revenue to offset the cost of all of this. You could literally confiscate all of the income of those, 100% of the income of those type of people, the high wealth individuals, and it's going to be a drop in the bucket compared to what they're spending. And so it doesn't balance out, and that would have ramifications across the economy too. Those are the major places as to where we're at right now. There's obviously, I haven't talked about the absolute pork that's in the bill, just focusing on the tax provisions. But another one that is important to us is right now, IRS cannot impose penalties on a taxpayer if they've got you under audit and you've underreported your income and you get above a certain threshold. Then they can hit you with some substantial penalties, 20%, and if it's willful disregard, you get to 40% of the underpayment amount. They're going to tack on a major penalty. Well, under current rules, they can only do that if they get supervisor approval. Well, now in this bill, an auditor would not need supervisor approval, and they've made that one retroactive back to year 2000. So that opens up the floodgate on penalties, again, for IRS to impose. So that's just kind of a brush up as to where we're at right now. We'll have to see what happens as we go on this week. Of course, they were supposed to vote on this last week. That didn't happen. And I'm still thinking that we may not actually get anything, or if we do, we get just a little bit of these tax provisions.
So in other words, 2 weeks from now when we come back and talk, we could probably have a whole new set of how this looks, too.
Yeah, indeed. We probably will revisit this in 2 weeks to see where we're at.
And by the way, too, later this week, as a matter of fact, you're going to talk more about this at another conference you're going to be attending.
That's right. I'm putting on a conference. It was originally scheduled to be in Laramie, Wyoming, but that, because of various things that have happened out in the Wyoming area, particularly with respect to the virus, we've moved that to entirely online. So even farmers and ranchers and lay people would get a benefit out of attending this because I'm going to be going through these proposals and what you can do and what might be a good move right now. Where does it look like we're at on Friday when I get to this conference and talk about these things? I'll be going through this for about 4 hours, so there's a lot of stuff that I'm going to talk about, but we'll give the current lay of the land as of that point in time.
All right, sounds good. Roger, as always, I appreciate it, and thank you very much. We'll talk to you in a couple of weeks.
Thank you, Greg.
That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the Ag Issues program here on 580 WIBW.